Hi there. Today I wanted to explain some of the details around seller financing. It is a very hot topic right now, but I have also noticed that a lot of the information being shared out there is inaccurate or possibly skewed to benefit one party over the others, and that doesn't work in seller financing. So, first, what is seller financing? Essentially, it is when a buyer uses the seller as the bank instead of a typical lender. So instead of you going to the bank, getting a loan, going through underwriting, appraisals, sharing your firstborn, whatever it is they're asking for, the seller of that property essentially is the bank for you. So it's different than what a lot of people confuse seller financing for contract for deed. Contract for deed is when that owner of the property holds on to that deed and still is the legal owner, and the buyer makes payments until their loan is paid off, and then they hand over the deed. That's not what seller financing is at all. Seller financing transfers the deed or warranty deed or who the actual legal owner is at the county recorder's office from the current owner to the buyer or new owner. So that is the one piece that is very, very different between contract for deed and seller financing. Now, in order for seller financing to work, it has to work for both sides of the transaction. And we'll get into that in a little bit. So there are essentially three pieces to a seller finance deal. The first is down payment. The second is what's the interest rate? And the third is what are the terms, meaning how long is the loan amortized for? And is there a balloon payment? And we'll talk about that in a minute. So all of these terms are negotiable in seller financing. Another big difference when you compare it to conventional or bank financing. The bank sets the terms for you and they tell you we can give you this rate based on your debt to income ratio, based on your credit report, based on how much money you're putting down. That dictates the interest rate along with outside factors as well. They also set how long the loan is for. Typically, with conventional home loans, it's 30 years. Sometimes you can get 20 or 15-year loans. So, one of the reasons that home loans are amortized over 30 years is because it makes that payment affordable. Whereas if you're buying, let's say, a $700,000 home and you're amortizing it, or your loan term is similar to a car loan, let's say 5 or 7 years, that payment would be astronomical. There's no way anyone would be able to afford that. So that's why they are extending that amortization out over a 30-year period, which makes that loan payment affordable for you. Now, in seller financing, everything's negotiable because it is between two private parties. And this is completely legal, but there are some factors that come into play and actually make it have to have it work. So down payment, for example, when you're buying a conventional loan or taking a conventional loan, you usually have to have a minimum down payment. With certain loan programs, you can put as little as 3.5% down. You'll be paying additional mortgage insurance in addition on top of your mortgage payment if you put anything less than 20% down with a bank. If you're buying a vacant land parcel, sometimes it can be as high as 25 or 30% required down because it's a higher risk loan. So they're making you pay that insurance to protect that loan and lender. With seller financing, the down payment's negotiable. So interest rate is another piece of the puzzle, the second piece that's negotiable. Now, that can be whatever both parties decide. With current interest rates being on the higher side right now, although they are starting to come down, right now this is being recorded in December of 2022, we're seeing them getting really close to that low sixes, maybe dropping below 6 now. The seller finance deals that I've seen are offering comparable terms, sometimes less, sometimes more. Again, it comes back to what each party needs. The third is that amortization that I talked about. But on top of that amortization, over, let's say, 20, 25, 30 years with a seller finance deal, one of the big differentiators that we often see is a balloon payment that's part of the terms. And what that means is Let's use an example. Let's say I have a 68-year-old individual that's selling a home and they own it free and clear and they are willing to do seller financing. The benefit to them is they will receive a steady payment every single month, but they will not own the home anymore. So when that loan closes, the deed is transferred into the new owner or the buyer's name, but they are making payments to that bank who is the seller or the former owner. So they get payments over a predetermined period of time. But if let's say that individual is 68 years old, they're not going to want to receive payments for 30 years, most likely. So they're going to have a balloon. They'll say, we'll amortize it over 25, 30 years, whatever they decide to make it affordable. But at the end of 5 years or 7 years or whatever is decided, that loan is due. So that individual knows going into that at the end of that time period, they're going to need to either sell that property or refinance it. So that's something to be aware of. Again, that's negotiable. So the third piece of the puzzle, and this is where I see most agents making their biggest mistakes when they try to negotiate seller financing. When they're representing one side or the other, they make it lopsided. So they make it beneficial to the person or party they're representing, and it's not attractive to the other party. Recently, I saw some properties that came out in our market that were being marketed with available seller financing because it's becoming a popular thing. But the terms were so strict and unreasonable that someone interested in buying that property could go to a bank and get better terms. So it just didn't work. For example, they were offering 30% down payment required. I think it was a 2 or 3 year balloon, so that loan would come due, and the rate was higher than what banks were offering. At that point, there are no takers, right? Why go into that when you can put way less down, you can get better terms, and you don't have a balloon? So that's an example of it benefiting only one side, benefiting the seller. So no, there are no takers. On the other side, sometimes I have been a listing agent for a property and someone brings a seller financed proposal to me, which I'm always willing to look at, and it's a starting point for negotiations and discussion. But they're coming to me. Sometimes it can be a buyer that may not be able to qualify for a conventional loan, or their down payment is so low that their payments would be too high with that bank, or the rate would be too high. That's fine. Let's see what we can do, right? But they come to me with something similar to, let's say, 2-3% down, maybe 5% down, with a 2.5 or 3% interest rate and 30-year amortization with a 10 or 15-year balloon, something like that. Well, that's going to raise some red flags for me. I'm going to want to know, where are these terms coming from and what's in it for my client, for my seller. So that's another example of someone on the other side not coming at it with the attitude that we've got to make it work for everybody in order for it to be a deal that we can close, right? One of the big advantages that I think I'd like to get out there that a lot of sellers don't realize is that if you've got a fair amount of equity in your property, when you sell that property, you are looking at paying fairly substantial capital gains during that calendar year that you sell it. So if you are an individual, it's up to $250,000 tax free that you don't have to pay capital gains are above, that profit that you make. If you're a married couple, it's 500,000. But with equity growth being so enormous over the last several years, I've seen a lot of people going beyond that in terms of what profit they're getting out of their properties when they sell, and they're being saddled with a fairly large tax burden. So one of the ways to avoid that is through seller financing with a balloon. So for example, actually, I'll share an example of a property I recently closed within the last month using seller financing. We had this property on market and we had gotten a couple of offers that were lower than what the seller was comfortable accepting, which is reasonable. We got an offer that again was slightly lower, but I said, hey, why don't we counter with a seller financed option? Or in this case, it was 3 options. So they were coming at it with 20% down, conventional bank loan. They were probably looking to have to pay 7 at that time, 6.5, 7.5%, probably in the low to mid sevens. and looking at a fairly steep mortgage payment with a large down payment. So what we did was we set up 3 scenarios where we proposed different loan terms. So we had different down payment amounts, which were considerably less than that 20%, competitive rates that were lower than the banks were offering, different amortization schedules, 20, 25, 30. There were a couple of different combinations that we offered, and a 5-year balloon. So we put this deal together and we closed on it. And so what this did for that buyer was it allowed them to get into the property with less money out of their pocket, with less closing costs. They avoided thousands of dollars in underwriting and appraisal fees from the bank. And they get the note. So the warranty deed, the deed of the property is in their name. They own that property. My client no longer owns that property. So here's what happened on the seller side. He did accept, and we closed on that property for less than what he wanted. However, he is now the bank. So instead of them making their monthly mortgage payments to a bank or a lender, they're making it to this individual. And there are certain ways that you want to set this up so that it's legal and so that it's accountable through a third-party servicer. So just leave a message in the comments or DM me if you have any questions about that. But there are certain processes that have to be put in place to make sure that everyone's protected. We also use an attorney to draw up these documents. So I don't ever advise anyone to try to scribble things on a piece of paper or draw up these documents on their own. There are plenty of real estate attorneys out there that will do it for a very nominal fee compared to what you're spending going through a lender. So what's happening here is this buyer is now paying my client a monthly mortgage payment of of principal and interest. The principal portion is not taxable because it is a loan repayment. The interest is taxable, but instead of receiving this giant lump sum of profit that he would have gotten in that calendar year and having to pay capital gains on it, the loan is being paid back over a period of 5 years. And so he's spreading out the tax burden over several years. The other piece of this puzzle is, yes, he no longer owns the property, but he owns the note or the loan terms just like a bank would. So if this party that purchased the property were to ever fail to make payments or if he had to foreclose on it, just like a bank would, if you don't make your payments to a bank, they can take the property back. He could get the property back. So I'm not suggesting that that's what we're doing going into this. And a lot of sellers say, I don't want the property back. But here's the thing. If you're buying a property, you're going to be putting repairs into it, doing work. And so you have a vested interest in keeping that loan current. But if for some reason you fall on hardship and that seller has to take that property back, make sure it's written into that contract that you're using through an attorney, but they're getting back a property that has been improved and they've already made money on that they can easily sell at retail. So those are a lot of perks to think about, but I can't impress enough upon those of you who are thinking about negotiating, whether it's with or without an agent, the necessary piece of it needing to be beneficial for both sides. So a lot of times in real estate, people come at it with a take no prisoners attitude. Seller financing is really one of those unique opportunities where everybody can win and everyone can do well as a result of us all working together. So I hope this has been helpful. Leave me a message in the comments below, or you can also reach me on montanagoodlife.com. Take care.